Welcome everyone back to another episode of Market Talk. Today we have Joe Valente from Tabatchouk Law, Kevin Dolan from AnnieMac, and my business partner Jeffrey Califoot. Welcome, gentlemen.
Good
Good
morning.
morning.
Right. So let's get into it. We've got obviously the war in Iran going on. We have some volatility in the market affecting some interest rates. Kev, do you want to touch on that a little bit?
Yeah, sure. So, yeah, spot on with that. Definitely volatility. I would we start by going back in time to the Friday before the Saturday that the war was announced was a really strong day in the market. Really signaled all of the technicals that move mortgage rates. Such as inflation, right? Was looking like it was headed down. Continue on the path down rather. Talks on future rate cuts. The 10-year Treasury bond was rallying lower. It actually broke 4.0, which was a big deal in the market. So, that was super exciting. We were like, finally, we're actually going to turn this corner and, start to see a little bit more momentum in rates going down. Because that was a big floor to break beneath that 4.0 on the 10-year Treasury bond.
Mhm.
And then boom, we're here at war with Iran. So when you talk about a knee-jerk reaction, we definitely saw it.
Yep.
But think about all the reasons why rates were positioned to go down is because inflation dropping, right? And so what happens when we look back in the conflicts that have been in the Middle East that involved oil? Pretty much every single time for a few weeks, oil shoots up, the price of oil, right? And the 10-year Treasury shoots up with it. And obviously that correlation causes mortgage rates to go up as well. So, when you start to think about oil becoming more and more expensive, that translates backwards to us, right? At the pump, transportation costs, the cost of goods going up, that's relative to anything that has, oil related to it, which is pretty much everything has to be moved and has to, be manufactured, and oil is pretty much a part of most of that. So all of this last, few years of watching inflation go down was now all of a sudden this huge risk that this oil price was going to make inflation go up, right? So in a
Mhm.
simple way, that's what made the markets move so aggressively. Now, the last piece of this is the ironic piece, is that when the price of oil essentially almost doubled for a few days there, right? That now became a recessionary risk because now this is going to be such an event of things costing so much more that this could actually slow our economy into a recession. And
Mhm.
now you had inflation and recession having a tug of war. The beautiful part about that for mortgage rates was that the bond market now sort of spit out the idea that inflation was going to be a risk and was biting a hold of the fact that, a recessionary risk was more likely. And, that actually brought mortgage rates down a little bit.
Mhm.
Then we had a ceasefire that helped for a second, and the ceasefire wasn't there, right? And then it was, we were obviously the Straits open, and then the Straits closed. So I will say that since this started, mortgage rates went up about a half a point on average, and since the beginning, we're back about halfway. So in all reality, about a quarter to 3/8%, is really where that volatility lies, higher than we were when the war started. I will tell you that when the war has a solution, or we can pass through the Straits of Hormuz again with oil, we should see the markets really come right back.
Yeah.
So volatility for sure. Timing is super important. It's absolutely impossible to handicap this. So, working with a mortgage lender, you can have the smartest guy in the room, and honestly, he or she should be saying, it's just impossible to say because
Right.
it's
Yeah.
been a roller coaster ride, and it's like two kids fighting in a sandbox right now. And ironically, that's what's controlling mortgage rates over the technicals, like the bond market and inflation and so forth. But
Mhm.
hopeful that this comes to an end soon, and we will be right back on that track to lower rates. Hopefully.
Hopefully, because we are
Fingers crossed.
seeing, yeah, fingers crossed. I mean, we are seeing an increase in incomes in the United States and in salaries. And also kind of put it in perspective, like January 13th of 2025, interest rates were sitting around, 7.26. And we're still, Kev, would you say we're sitting around like six and a half, six and a quarter, a little bit?
Yesterday's the national average was like 6.3.
Yeah.
With some, those national averages don't they don't discount like what people are paying for those rates. So,
Hmm.
People buying rates down and points and so forth are still included in that. But yeah, I would say like, in the low to mid sixes,
Mhm.
whereas like a month and change ago, we were sort of knocking into that the five handle, right? We were
Yeah.
locking rates 5.875, 5.99, things like that, without some small cost or no cost. Right now,
Mhm.
the competitive rate out there for an A plus borrower is like 6.25 ish. So it's not dramatic, but
No.
it
Yeah.
definitely turned things back the other way. And I think that's where it got concerning, right? It's that how far it could have gone.
Right.
And I think that we've put a lid on that. I don't see this thing, even with some escalations continuing potentially here and there, right? And
Yeah.
not getting the solution perfectly ironed out and the little bumps in the road that come with that. I don't see rates going over the mid sixes here, to be
Right.
honest,
Yeah.
unless things
Especially.
really not crazy.
Right. Especially in this situation, it seems like things are changing, day to day. Like it's not, taking months to make decisions or months to make changes in action. So it's like the market's it's even hard to, react to it because it's happening so fast and things are changing so quickly. So yeah, we'll definitely keep an eye. But in the grand scheme of things, there's still more affordability than there was, a year from now, year previous, in my
Yeah, and
opinion.
it definitely, it had this all had a huge impact on what was going on out there, right? As far as, we had a bunch of activity kind of building up into the spring.
Yep.
Iran happened, and then all of a sudden, everybody kind of, not everybody, but a majority of the people that year I was working with kind of took a pause and they're like, okay, let's see where this goes.
Mhm.
And a number of the buyers I was working with, they kind of took a back seat for a little bit. They're coming back into play again. You look at just the number of listings on the hot sheets day to day. We're seeing an increase over the past few days, more so than we were a couple weeks ago. So I think we're having almost like I don't call it like a delayed spring market, but it's almost like what was ramping up kind of paused, and now I think we're getting back into it again.
Yeah. Um, Joe, what are you seeing, in New Jersey and in New York in regards to transaction? Are you seeing any delays or any pauses?
Yeah, 100%. Just reiterating a lot of what Kevin said and Jeff said. You know, on our market talk in February, I don't know the exact date, but it was before February 28th, which was the so-called War of Iran start date. We said things like, "This looks like the first spring market in years. All all factors are pointing towards a strong spring market." However, we always said there's some unknown factor that could change that. Well, that there
That
was an
was
unknown
it.
factor that changed it. And that's why, like, I shake my head and laugh. Like, you could do all the prognosticating, right? Everything could line up in real estate to be a strong market, and then something like this happens. The only good thing is that I do think, like Kevin said, and you said, Jeff, like, we call it a delayed spring market, call it what you want, but everything's there that once de-escalation happens, that's those strong factors are still there. They're just
Mhm.
kind of put on pause for the time being. So
Yep.
I think we'll have, just the same type of market we expected, just pushed out a few months. So,
Yeah.
there's positivity. The problem in this industry is, how do you find those months where things are slow to keep your business going, right? We're all out there running our business. So, you know, there's activity. It's not the same rampant activity that you would expect in April 21st.
Yeah.
Attorney review is usually 2 days on April 21st. I'm seeing drawn out attorney reviews.
Yeah.
Buyers are being more tactical in what they're looking for in inspections.
Mhm.
Sellers are trying to go into more weekends to get other offers because the offers aren't pouring in like they normally do. So
Yeah.
there's a lot of that right now.
Yeah. No, that's 100% accurate. I had a listing. The deal actually just died, and it's my seller's fault. you know, he owns it, but it took forever to even get that. It was, again, small studio type of place, right? In a market that doesn't have a lot of those. It was hard to sell initially. I put that back on the market. I had multiple offers within 3 days, and we're in review. Should be under contract tomorrow. It's what took a while during
Yeah.
that little hesitation period now is flying.
Mhm.
So same thing. Another house I listed out in Bloomingdale. first weekend, decent activity at open house, no offers coming in, one low ball from an investor, and all of a sudden, one more weekend of showings, and I had multiple offers, had to go highest and best. There's definitely a rebound from all this happening.
Yeah. I mean, in the Northeast, we're still seeing probably a month, 1.5 months of supply in the inventory. But in, like Texas and Florida, we're seeing a flattening in the market, and we are seeing some home values decrease because of, certain situations. But in the Northeast, we're still pretty strong in regards to if a good house comes on the market, that thing's flying off the market, off the
Yeah,
shelves
Yeah.
for
there's
sure.
definitely still that quotient for sure.
Yeah. Joe, I wanted to get your opinion on New York's strategy of the was how do you, I'm going to butcher this, the prix de terre, the tax that is the surcharge tax that's going to be on luxury properties in the 5 million range that is not their primary residence. How do we see this possibly affecting the luxury market in New York City?
It's definitely going to have an impact. So the people that money ain't a thing to probably will still move forward like they planned. But those threshold buyers who have, obviously you need money. That's the starting point for pied a terre. You don't have a pied a terre if you don't have money
Hmm.
um, in, investment accounts and different things. But yeah, that may dissuade them from wanting to operate like that for sure. I mean,
Right.
who wants to pay an additional tax that gives them no value in what they planned on doing before this was announced? Um, it gets harder. I always say this: it gets harder and harder every year in real estate, whether you're a buyer, seller, or professional working in the space. There's never legislation that drops that makes it easier. Like, whether it's the mansion tax being shifted, that
Yep.
all that does is make our life more difficult. That in no way helps us, right?
Right.
It always takes. It always takes. I always say it takes 6 months for things to settle when news breaks. Those
Hmm.
first 6 months, things are always affected in that space, and then
Right.
generally people tend to forget, whether it's an increase in mortgage rates and they neutralize, whether it's new legislation passing, like we just talked about the pied a terre luxury tax. So it affects it short term. Eventually, if it's not going to change, people as a whole, not everyone, but the majority will still probably proceed as they wanted to. But it's going to cause a temporary shortage or a slowdown of that market for sure.
Yeah. I mean, obviously every action has a reaction, right?
Right.
They're looking to generate around $500 million in revenue from this tax. When it takes place, what is going to be the trickle down effect? Not every, yes, granted, some people won't care, right? Some people with
Right.
that amount of money won't care, but there's going to be a large portion, and it's like, hey, I'm not going to get anything for, you know, not going to get any return on this, then I'm going to strategize not to pay this. Whether I
Yeah.
sell my $5 million unit and I get a $4 million unit because I'm only there 6 months out of the year, so I can suffer a little bit in a $4 million unit. So
Yeah. It's definitely going to, the trickle down effect is that it's going to hurt the seller ultimately because
yeah,
their pool of buyers is going to diminish. Even if it's by 20%, it's still going to shorten that buyer's pool. So the trickle down effect is those luxury units are certainly going to be affected in their sale price for sure.
right.
Joe, are you
And
seeing anything with your New York clients related to I guess I'll just put it this way, the political environment in New York City right now? Are
I
you seeing?
definitely, there was honestly initially an uptick of activity, and it was all focused around cash buyers who were a little unsure about their investments and
Right,
wanted to diversify and get some money out of accounts and into real estate, which is a little safer during tumultuous times like this.
right.
So there was definitely an uptick like that. Now it's neutralized and it's kind of it's still an active market, but there was an initial flurry of cash buyers in New York. I would
Yeah,
say early March, the month of March in general, and now it's kind of flattened out.
yeah.
Yeah. Yeah, it's interesting. I mean, they're looking to obviously generate around 500 million in revenue, but like you said, the trickle down effect is like next year that might be 400 million, 300 million as people start getting smarter and be like, "Hey, listen, I'm not buying a $5 million unit or above."
Yeah, and I'm not sure that like sometimes the city doesn't think things through or the state think things through
Get out of
because
here,
Are you
Joe.
serious,
Are
Joe?
you
the
are you
thing is
kidding me?
they get it in New York City. The city gets a transfer tax of 1.425% on any property over 500,000. Right.
Mhm.
The state collects 0.4% on any sale in New York. So yes, you may create additional revenue, but you're shorting your revenue because the sale prices are going. So like you're taking money out of one pot, you're making people really upset, and I don't know. I don't think a lot of this stuff is well thought out sometimes.
Yeah, I concur, my friend. I concur. Um, but yeah, I mean, so long story short, we are seeing somewhat of a spring market in our area. It is slower to the starting line than we would like. I think I agree with Jeff. People have been kind of hitting the pause button. We have seen, I have buyers too that I have probably 3 buyers right now that have said, "Hey, listen, we're going to pump the brakes. We're going to give it another year." Is that the smartest move? Don't know, but they're not in a rush and they're kind of waiting to ride this out a little bit. So yeah. Um, anything you guys want to add? I mean, there's a lot of moving parts going, and there's no such thing as perfect advice. There's expert advice, and that's what we try to provide from our perspective. But there's never perfect advice because it's such a volatile time, and things can change, day by day for sure. But anything else you guys want to add?
Yeah, I think I'm piggyback on that. There's really no timing this market, right? And people kind of always say, "When's the best time to buy?" Those kinds of comments, and it really is always when it's good for you. And I think that's what people need to. If you put your blinders on to all the world around you, if we fast forward a year from now, it'll be another factor that's making a challenge or a ripple in the market, right? So,
Right.
there's just never a perfect time. It's perfect when it's right for you, and obviously aligning yourself with your goals and understanding what those are, and if you're hitting them and you're getting from point A to point B, and it's what you want, and that's a good time for you, right? Then that's what you should look at. And I think if you said, "Oh, I'm going to wait for the war to end," or "I'm going to wait," it'll just be another factor that comes up that'll get in your mind or give you a mental block. And so the best starting point is to really it starts with that idea of wanting to do something and get with the experts, right? And figure out if it works for you. If it works for you, then it's the right time.
If it makes sense, if it makes sense,
put
it
the
makes
noise away.
sense. That's it.
Yeah.
Right. Like you got to look at real estate like any type of investment, right? You're never going to time any financial market perfectly. If
Right.
you have the ability to do it and it makes sense for you, get your money in. It's always going to be a good investment over the long haul. That's kind of how you got to look at real estate. So there's going to be positives and negatives for a buyer at any time, right?
Oh yeah.
The positive right now is you may have a little less competition. The negative is your rate may be a little higher. However, you may be able to refinance when things calm down. If you wait, yeah, you may have a better rate, but you're going to have a lot more competition. So there's
Right.
always, there's two sides of every coin, right?
We're in a very funky cycle right now for the past, 6 years now.
Yeah.
At what point do we just dub it like, how long
Is,
of a period is it just a funky existence?
is
Yeah,
McDonald's
I mean,
is McDonald's hiring? Let's
It's been a wild ride. It's definitely a roller coaster. All of us in the profession and all of our clients out there trying to buy and sell. But there's always going to be people that like life situation, like circumstances happen, right? Like I have 2 houses going on the market today, and one's just they have to downsize, because of finances, and they can't take care of the property anymore. The other one is unfortunately it was a death. So homes are still going to hit the market. Buyers are still out there. And I feel like we're definitely picking up, especially this week compared to the previous few. You could see houses are still hitting the market, and there's still some activity, and there's still multiple offers on certain properties. But when you look at like Long Valley, for instance, and you see 15 homes on the market in April, that's insanity.
Yeah.
That's way below where we should be in the spring.
Yeah.
Yep.
Well, all this is kind of gearing towards a point when we don't know when, where if you're a real estate professional, whether you're a lender, you're a real estate agent, you're an attorney, title company, the dust is going to settle, and your family's going to dislike you because you're going to be so busy, you're not going to have time to sleep, eat, we don't know when that is, but it's all gearing up to that point. It's going to happen.
Yeah.
I agree. I agree with that. But to be continued. Thank you guys for joining us again. It's look forward to next month. A lot of things can change until then. That's for sure. Keep it interesting, right?
Yeah.
Awesome.
It's exciting.
So exciting.
A few other words there, Jeff.
Yeah. That's why I still have hair. No, just joking.
Yeah.
But awesome. All right, guys. Thanks so much for joining us, and look forward to the next one.
Thanks,
Thank
guys.
you.
Take care.